Subway is now shuttering a huge number of stores. The company has been struggling financially for years. Right now, executives are trying to sell the decaying franchise to the highest bidder.
What is happening to Subway? Is the world's most renowned sandwich shop in the beginning stage of its downfall? Watch this video to learn more. Subway, the world's largest sandwich shop chain, is currently closing a large number of stores, as reported recently. These closures have resulted in the chain shrinking to its smallest size in nearly 20 years. The company has been facing financial difficulties for a long time, and now its executives are attempting to sell the struggling franchise to the highest bidder. Several factors, including the retail apocalypse, controversies, and tough competition, are negatively impacting Subway, causing significant damage to its position as the largest sandwich shop chain globally. Subway operates over 37,000 restaurants in 100 countries, making it the largest fast food chain in the world in terms of size. It experienced rapid growth during the 1980s and 90s, and even managed to remain profitable and expand during the Great Recession, which helped it become a market leader. By 2013, it had captured 41% of the market share among limited service sandwich chains listed in the economic top 500, putting it on par with other giants like McDonald's. However, this figure does not fully illustrate Subway's dominance, as limited service sandwich chains also include different concepts like Panera Bread and Arby's. Subway, which once dominated the sandwich market, has faced a significant decline in recent years. In 2015, Subway's share of the limited service sandwich market dropped by 28%, while competitors like McDonald's claimed 47% of the burger market and Chick-fil-A held 41% of the chicken market. This decline has intensified competition within the sandwich market. One of Subway's main issues has been its well-documented financial problems. The company expanded too quickly, often forcing franchisees to open stores near existing locations. This led to each store generating less revenue, eroding Subway's overall operations. Rising operational costs, falling sales, and declining profitability compelled many franchisees to close underperforming stores. Recent data from Reuters reveals that nearly 600 Subway restaurants in the United States closed their doors in the past year alone. These closures add to the thousands of stores that have shut down in recent years due to overexpansion, outdated operations, unappealing decor, and a menu that has failed to adapt. The chain closed over 1,000 stores in 2021 and 1,609 stores in 2020. Since 2016, more than 6,500 Subway restaurants, or 1 in every 4 locations, has disappeared from the US market. The situation within the company has become increasingly problematic, with franchisees reporting growing issues. Some franchisees have spoken anonymously, stating that Subway makes it nearly impossible to sell their stores and that the company charges markups of up to 700% on products. Franchisees feel threatened and fear being targeted by Subway. Analysts and business professors such as Jenny Buchan explain that Subway's problems are deeply rooted. The company controls prices and determines which suppliers franchisees can purchase from. In one example, an approved supplier charged franchisees $7 for dishwashing liquid, while a similar product costs less than $1 at a local supermarket. Overall, Subway's decline can be attributed to a combination of financial missteps, increased competition, and internal issues, leading to store closures and franchisee dissatisfaction. Franchisees have limited control over their expenses, with the exception of employee hiring and wages. Jenny Buchan emphasizes that franchisees lack discretion in other aspects of expenditure. The worsening relationship between corporate executives and franchisees, along with multiple lawsuits and scandals, including the infamous case of Subway's former spokesperson Jared Fogle, who was convicted of heinous crimes, has hastened the downfall of the fast food giant. Subway is now attempting to sell its business to the highest bidder. This decision follows the passing of Peter Berg, one of the company's founders. Subway is privately owned by the founding families, and Berg's 50% stake was entrusted to CEO John Chidsley through the Buck Foundation, where Berg's sons work. The chain is undergoing a restructuring process to address declining sales, revenue losses, and controversies. The ongoing store closures are also affecting public perception, and it may be challenging for Subway to distance itself from this negative perception. Franchisee advisor Robert Edwards mentioned that continued closures could have a detrimental impact. Meanwhile, corporate leaders are pressuring franchise owners to increase sales and profits as they attempt to attract a buyer. To attract private equity firms for a potential sale, Subway is showcasing revenue and earnings that suggest the company could be valued at over $8 billion. However, to achieve desired financial results, Subway has reportedly started imposing the cost of expensive store upgrades on operators while eliminating fees for prospective operators. The company is also cracking down on franchisees seeking to close underperforming locations to avoid raising red flags that might scare away potential investors. The report mentions a case where a longtime franchisee on the East Coast wanted to close 2 unprofitable stores, which would normally not be an issue since their 5-year licensing options were expiring. However, Subway changed its policy on expiring leases and demanded the operator to sell all their restaurants, including the profitable ones. Franchisees who sell are restricted to using Subway's self-appointed broker and must seek approval from the company for any sales. In some instances, franchisees have expressed frustration that Subway wants them to sell stores at significantly reduced prices. Overall, Subway is facing challenges including lawsuits, store closures, financial difficulties, and internal disputes as it tries to attract potential buyers and recover from its decline in the fast food market. Subway owners are currently being compelled to invest significant amounts of money in mandatory upgrades or face fines and the potential loss of their stores without any compensation. In addition to store renovations due in 2024, Subway requires owners to purchase expensive ovens and toasters, costing $5,000 and $6,250 respectively if their current models are over 7 years old. They also need to acquire new digital cash registers. Franchisees feel pressured to invest in store upgrades before an investment company takes over and potentially requires further expenditures. Subway's sales performance is disappointing, with stagnant or only marginal growth reported by franchisees. The uncertain future of their stores adds to the concerns of small operators. Despite the desire of sophisticated and financially stable multi-unit operators to enter the Subway system by purchasing multiple restaurants, they walk away after realizing the limited profitability of the stores. Although Subway has not disclosed the average annual sales volume for its US restaurants, industry experts estimate it to be less than $500,000, which is relatively low compared to rival sandwich shops like Jersey Mike's and Firehouse Subs, which generate over $1.1 million and $900,000 respectively, according to QSR Magazine. Currently, no potential buyers have shown interest in rescuing the struggling chain, as Subway's problems and challenges make it unattractive. It appears that Subway's empire is crumbling, and what has been observed so far is likely just the beginning of its downfall. Subway's sales performance has also been lackluster, trailing behind its competitors in the sandwich industry. With no potential buyers expressing interest in saving the chain, Subway's future looks uncertain, and its collapse seems imminent. The downfall of Subway serves as a cautionary tale for businesses, highlighting the importance of strategic decision-making, maintaining positive relationships with franchisees, adapting to changing consumer preferences, and prioritizing transparency and fairness within the organization. As we witness Subway's empire crumbling, it becomes evident that the challenges faced by the company are profound and require significant efforts to overcome. The story of Subway's decline serves as a reminder of the ever-evolving nature of the business landscape and the importance of staying vigilant and adaptable in order to sustain long-term success. That's it for this video. Thanks for watching.